Hey, what's up, everyone? Welcome back to another Tax Tip Tuesday where we discuss real estate related tax topics. And today we're going to discuss a topic that I probably get more questions on than any other tax topic out there, and that is the choice of business entity. And it's probably also where I see the absolute most misinformation on. And if you ever log into the Bigger Pockets Facebook group, this question comes up all the time. There will always be a million answers, and almost every single one of them will be incorrect in some way. This is a very confusing topic. It's a topic that's very unique to your individual circumstance. So it's hard to give general guidelines on it, but that doesn't stop people from trying. Okay, so we're going to dive into it today. And it's, again, what is the right entity choice for your business? So you've probably heard of like LLCs, C Corp, S Corp. That's a business entity, and the choice can have pretty big consequences for your business when it comes to both taxes and legal protection. All right, so let's dive in here and look at all of them. So what are your entity choices? There's really four choices here. The first is a sole proprietor or general partnership. And this is simply when there's no actual entity formed, right? You don't go and set anything up with the Secretary of State. You just hit the ground running. You never form a formal entity, and you and your business are basically one and the same. There's no separation between you two. The next step up is an LLC, a limited liability company. And this actually is almost exactly the same as a sole prop or a general partnership. All right, there are no tax consequences to an LLC. It's not even recognized by the IRS. Lots of people get this wrong. This is a legal entity only. Again, no tax consequences, right? But what it can potentially do is separate you from the business and offer you potential legal protection by doing that. The next one is an S corporation. And this is kind of the opposite of an LLC. It is not a legal entity. It is a tax election only. Right? So you have your legal entity like your LLC, and then you can make a S Corp election on that, and it's a tax election. And it offers potential tax savings, potentially significant tax savings, but only on earned income. And we'll dive into that in a little bit, but that basically excludes rental properties. Finally, we have a C Corp. This is just a corporate structure that allows investors to invest into it. So think a lot of the bigger businesses, like Facebook, we mentioned Facebook. It is a C Corp. You can go buy shares of Facebook and you have ownership in that company. Very few real estate owners like you and me are going to use a C Corp for their investments. It's going to be typically much larger companies that do that. So we're not going to talk about the C Corp today. All right, so let's look at some general guidelines of each of the three that we are going to talk about. First, the sole proprietor general partnership. Again, this is just, you don't actually set anything up. It's the easiest and cheapest to set up because of that. It does open you up to potential legal risk, but that may be able to be offset by being properly insured. And I'm going to say something right now that I'm going to probably repeat 4,000 times before this is over. Talk to an attorney, talk to an insurance professional, and see if you are okay to operate as a sole prop in a general partnership. Because many people are, and they can save a lot of money on this if they're properly insured. But I'm not an attorney. I'm not an insurance professional. Don't take my word for it. Talk to your professionals on that. Next, we have the LLC. Again, this is going to operate exactly the same as the sole prop and general partnership for tax purposes. What it does offer is potential legal protection, right? So it's going to almost act as that wall between you and your business, right? That can potentially protect you. There's a lot of ifs and buts in that. So again, I'm going to mention it again. Consult your attorney to see if that protection is necessary for you. Finally, the S Corp. The S Corp is going to offer significant tax savings for highly profitable earned income businesses. So again, earned income is, in real estate cases, when you are buying a property, fixing up, and selling it for a profit. That's earned income. When you're buying a property and holding it long-term as a rental, that rental income is passive income. So there will be no benefit to having rentals in an S Corp. Never hold your rentals in an S Corp, right? It's going to cause you to have to do things that are going to be a little bit of a pain. They're going to cost money, and it will have absolutely no benefit. So there's always exceptions to the rule. I've never personally seen one. Never hold your rental in an S Corp. All right, so let's look at some few quick examples here to break that all down. If you have a rental portfolio, you should be holding them in either an LLC or just as a simple sole proprietor or general partnership. Right? And again, a sole proprietor just means you're by yourself. General partnership means you have other partners with you. So you and one other person, you and 10 other people, it doesn't matter. If you don't set up an entity, you're going to be a general partnership. Being properly insured offers better legal protection for most people than an LLC. That's my opinion as a CPA. Talk to your attorney and your insurance professional. But an LLC can offer significant protection in certain cases. So for some people, an LLC, number one, it could just be peace of mind. Right? It offers a little bit of protection, or at least separation, and just the thought that that could protect them is enough for most people or a lot of people to consider doing it. And in many states, it's super cheap. Right? If you're in California, it's going to cost you at least $800 a year. In most states, it's going to be a couple $100 or maybe even much less than that per year to keep that LLC going. Right. For those of you who make significant profits flipping houses, an LLC that's taxed as an S-Corp could make sense. Right? An S-Corp designation saves you money on Social Security and Medicare taxes. So when you're self-employed with earned income, you are paying both sides of the Medicare and Social Security taxes. If you're an employee, you're just paying your side of it. When you're self-employed, you're paying both sides of it. An S-Corp can help you reduce those Social Security taxes. Right? So if you are very profitable, it can offer significant savings. And I hate throwing out a general line here. People always want to know a number of when they should consider it. I hate doing it because it's so unique to each person. But if I have to throw out a number, I'm going to say $75,000 a year in profit. If you're flipping houses and your profit after all expenses are accounted for is $75,000 a year or more, I would start looking at an S corporation. But again, for some people that number is going to be lower. For some people that number is going to be higher. So I'd be talking to your tax professional right now, no matter where you're at, just to see when it could make sense for you. All right, conclusion, your choice of business entity for your real estate purchases can have a huge impact on both your legal and your tax exposures. Right? Every person's situation is different. You should be talking with competent tax and legal professionals, and I'll throw in insurance professionals, before making a decision on this. But two things to always remember: an LLC offers no tax benefits, no matter what your uncle's friend's sister tells you, and never put your rentals in an S corporation. All right, hopefully this video was helpful. This is a very important topic. Again, it's very unique to your personal situation. Talk to your professionals. Talk to them early on so you can plan ahead of what you're going to do. And if you found this video helpful, be sure to like and subscribe, and check in next week for our next tax tip.